What is the instant analysis that we should take away from this data?
We saw a big improvement in consumer sentiment in August, and what we've seen is that improvement has not continued through September. Consumers are seeing a lot of uncertainty in the world today, and in spite of the fact that inflation does seem to be slowing down, there's a lot of uncertainty. Our inflation expectations came down a little bit for both the short term and the long run, but what that obscures is quite a bit of disagreement and a lot of uncertainty among consumers. They're seeing a lot of mixed signals around them, and they're not sure what to make of it.
Fair enough. For the one-year inflation expectation, I mean, 4.6%, I understand sequentially it's lower, but that's still pretty high.
Yes.
Do you guys have a read on what would make that eventually roll over?
So 4.6% is much lower than we've seen in the past year, but as you've said, it's still at an elevated rate. What we're not seeing is that even though inflation is slowing, it's not really made a material difference in how people feel about their personal finances. Consumers are still telling us that high inflation, high prices are really eroding their living standards. So it's really going to take some sustained improvements in inflation for that number to come down materially.
That's how they're thinking, that's how they're feeling. How does that tie up with how they're acting, do you think?
Well, as we've seen over the last few months, in spite of the fact that consumer sentiment has been near record lows and continues to be near record lows now, consumer spending has been fairly robust. And one of the reasons for that is the strong labor market. Unemployment is low, people feel very secure about their incomes, and that's what's supporting consumer spending. If as the economy proceeds, there's any softening in the labor market and people start to feel a little bit less confident about their incomes, I expect them to really pull back their spending and match their precautionary stance with respect to the economy.
And we match that with the housing information, which you're looking at 30-year mortgage rates now over 6%. Have we seen the full effect of that part on confidence yet?
We're starting to see effects of that, of higher interest rates, not just in terms of houses, but in terms of other goods, durable goods and auto loans as well. That said, I think we haven't seen the full effect of that yet. About 80% of consumers expect further rate hikes over the course of the year, so they are expecting interest rates to go up even more. And so I expect that those effects will continue to increase over time.
Joanne, what's the correlation between the value of the equity market, let's call it the S&P, and how consumers feel?
The relationship, I believe, is weaker than what many may think. The average American consumer is not actually paying that much attention to equity markets. While a large share of consumers will spontaneously mention supply chains, Russia and Ukraine, gas prices, very few of them actually mention the stock markets. So for those who hold equities, which is not an enormous share of the economy actually, or the population, they are certainly going to be watching their account balances, and that'll certainly affect their sentiment. But for those who do not hold much directly in equities, they're not paying attention that closely, and they're not going to be that influenced.
And they're not going to retire anytime soon with their 401k. Maybe they're able to avoid that statement looking. I want to ask about the persistent moderation in prices that you were talking about earlier, that consumers are going to need to see more moderation in prices. Do you have an idea of what that looks like? Like, are we talking 6 months of lower prices? Is it just a couple more readings of lower prices?
It's hard to say. So if you look back in history, in the late 70s, early 80s, we did see some moderation in prices that were followed by increases yet again. So I'm not sure that anyone's really looking back to history that far in thinking about prices right now. But gas prices are quite volatile. Food prices are quite volatile. So I can't give you an exact number in terms of the number of months of sequential decreases in inflation, but certainly it's going to have to be more than 2.
Joanne, if you were to wrap this all up, sum it all up, how would you describe the situation? How would you describe this report and what it tells us about the U.S. economy?
Essentially, just like the rest of us, American consumers are generally seeing very mixed signals in the economy. They're seeing the bite of high inflation, the reduction in gas prices, food prices going up, as we saw in the most recent CPI release, and strong labor markets. All of these things are kind of going in somewhat different directions, and that's feeding into a lot of uncertainty. Consumers aren't sure what they're looking at, and so we'll see if the tentative improvements we've seen over the last couple of months will continue.